Do you think your money is safe and growing in your bank account? Think again. The truth is, your money is losing its value every day due to inflation. The interest rate that the bank pays you is not enough to keep up with the rising prices of goods and services. You are actually losing your purchasing power by keeping cash in the bank. This is why you need to invest in assets that can protect your wealth and help you create a legacy for your future generations. In this video, we will reveal some assets that can do just that. Classic money. Gold, silver, and platinum. Money is supposed to be a store of value, meaning that it should retain its worth over time. However, governments around the world print more and more money to fund their spending, which reduces the value of each unit of currency. This is why you need to invest in something that is scarce and cannot be easily created out of thin air. This is where precious metals come in. Precious metals such as gold, silver, and platinum have been used as money for thousands of years. They have intrinsic value and are recognized as a universal medium of exchange. They are also a hedge against inflation, meaning that they tend to increase in value when the cost of living goes up. For example, before the 1950s, you could buy an ounce of gold for $400. In 2023, the same ounce is worth more than $2,000. And according to some experts, it could reach $10,000 by 2032. That means your gold investment could multiply by 5 times in the next decade. The same goes for other precious metals like silver and platinum. They are also better than holding cash in the bank, which is losing its value every day. If you want to invest in precious metals without buying physical bars or coins, you can use gold ETFs. Gold ETFs are investment funds that track the price of gold and trade on stock exchanges. They are easy to buy and sell, and they give you exposure to the gold market without having to store or transport physical gold. Stocks and mutual funds. Treasury securities may provide better returns than cash, but they also offer lower returns than stocks. This is because they have lower risk, and lower risk means lower reward. But not all investors are looking for high risk and high reward. Some investors prefer steady and stable returns with moderate risk, and stocks can provide that too, if you know which ones to choose. The stock market is broadly divided into 2 types of stocks: value stocks and growth stocks. Growth stocks are those that have high potential for future growth, such as technology stocks. They are risky because they depend on uncertain factors like innovation, competition, and consumer demand. Value stocks are those that have low prices compared to their earnings, dividends, or assets, such as industrial stocks. They are less risky because they have established businesses with steady cash flows and profits. Value stocks not only provide consistent price appreciation over time, but also pay regular dividends to shareholders. Dividends are portions of a company's earnings that are distributed to investors as a reward for holding its stock. Dividends can provide you with passive income and also protect you from inflation and market volatility. However, finding value stocks that have strong fundamentals and attractive dividends can be time-consuming and difficult for average investors. That's why many investors use mutual funds to invest in value stocks. Mutual funds are pools of money from many investors that are managed by professional fund managers who select and buy stocks on their behalf. You can invest in mutual funds that focus on value stocks and dividends. Collectibles. Some things are more than just things, they are treasures. They are rare, unique, and beautiful. They are collectibles. Collectibles are items that have a high value because of their scarcity, quality, or history. They can be anything from vintage cars to rare art pieces, from handcrafted luxury handbags to limited edition watches, from first edition books to signed memorabilia. Collectibles are different from ordinary items because they appreciate in value over time instead of depreciating. For example, a regular car loses half of its value as soon as you drive it off the lot. But a vintage car, like a 1962 Ferrari 250 GTO, can sell for a staggering $48.4 million in 2018. Only 36 of these cars were ever made, making them extremely rare and desirable. Similarly, in 2019, Claude Monet's painting Mules Part of his famous Haystack series was sold for a whopping $110.7 million at a Sotheby's auction too. The painting is considered to be one of the masterpieces of Impressionism and the most iconic representation of rural life in France. The reason why the rich spend huge amounts of money on collectibles is that they are timeless stores of value. They can fetch an unimaginable price if you find the right buyer. They are also expressions of taste, status, and personality. But you don't have to be rich to invest in collectibles. There are many online platforms that allow you to buy and sell rare and valuable items, such as eBay. eBay is a marketplace for selling anything from coins and stamps to dolls and toys. You can also invest in partial ownership of collectibles on platforms like Rally4 and Otis. These platforms let you own a fraction of a collectible item, such as a sports card or a sneaker, and share in its appreciation. Sovereign guarantee. Have you ever noticed the words on the dollar bill? It says, "This note is legal tender for all debts, public and private." What does that mean? It means that since 1971, when the US abandoned the gold standard, the dollar became the official currency by law. It became valuable because people accepted it as a means of payment for goods and services. But unlike gold or silver, the dollar is not backed by any physical asset. It is only backed by the trust and confidence that people have in the US government. But how stable is that trust and confidence? How strong is the US government? These are important questions to ask, because your money is only as good as the government that issues it. This is why investing in sovereign guarantee is a smart way to preserve your wealth. Sovereign guarantee means that the government of a country promises to repay its debt obligations. It means that the government will not default on its loans or bonds. It means that the government has a strong and stable economy and political system. Investing in sovereign guarantee means investing in the debt securities issued by such governments. One of the safest ways to invest in sovereign guarantee is through government securities or G-SECs. These are bonds or notes that the government sells to raise money for its spending. They pay a fixed interest rate and have a maturity date, when the principal amount is returned to the investor. However, not all G-SECs are equally safe. Some governments have a higher risk of defaulting than others, due to their weak economic or political conditions. For example, in 2009, Greece faced a severe sovereign debt crisis and had to be bailed out by international institutions multiple times. Therefore, you should always check the credit rating of a government before investing in its G-SECs. They offer better returns than keeping money in the bank, and they are also considered risk-free investments. You can buy Treasury securities directly from the government through the Treasury Direct website, or from the secondary market through brokers or dealers. Safe haven currencies. In today's world of fiat currencies, where no currency is backed by gold or any other tangible asset, the stability of a country's economy and politics is very important. This is why the rich always keep some of their money in Swiss banks. Switzerland has one of the world's strongest and most stable economic systems, which makes it a safe haven for investors who want to protect their wealth from uncertainty and volatility. The Swiss franc is considered one of the safest currencies in the world. It tends to appreciate in value when there is turmoil or instability in other countries. We have seen this happen many times before. For example, during the Eurozone debt crisis in 2009 and the global financial crisis in 2008, many investors moved their money from Europe and the US to Switzerland to avoid losing value due to currency depreciation. Also, the Swiss franc acts as a valuable alternative to the US dollar for international trade. In early 2023, one Swiss franc was worth $10.74 US, making Swiss franc holders richer overnight. Other currencies that are considered safe havens are the British pound and the Chinese yuan. They are also more stable and reliable than holding cash in the bank, which can lose its value anytime due to inflation or political interference. If you want to invest in these currencies without opening a bank account in those countries, you can use currency ETFs or forex brokers like Forex.com. They allow you to buy and sell different currencies with as little as $100. Industrial commodities and raw materials. Another way to invest in scarce and valuable assets is to look at industrial commodities and raw materials. These are the building blocks of many products and services that we use every day. For example, silver is not only a precious metal, but also a vital component of electronics, medical equipment, nuclear reactors, and more. Other metals like cobalt, nickel, and copper are also in high demand due to their unique properties and applications. These commodities and raw materials tend to increase in price when there is a surge in demand or a shortage in supply. For instance, since 2020, the demand for cobalt has skyrocketed because of its essential role in producing batteries for electric vehicles. As a result, its price has risen from $20,000 per ton in 2012 to $40,000 in 2022. That's a 100% increase in just 10 years. However, investing in these assets is not as easy as buying physical gold or silver. You need a lot of money, storage space, and market access to buy and sell them. That's why many investors use alternative ways to gain exposure to these commodities and raw materials. You can invest in stocks of mining companies like Rio Tinto, mutual funds that focus on the mining sector, or derivatives like futures and options that track the price movements of these assets.